Good morning, everyone. I'm Greg Farinello, head of U.S. rates for AmeriVet Securities, and welcome to Monday Minutes. Very brief recap from Friday. We've talked about the employment number, obviously largely advertised and expected, very devastating number, the biggest on record since we've been keeping records of the employment picture. We tend to look at the U6 rate, which includes the underemployed, and if you look at that rate relative to the U3 rate, even going back to the 2008 financial crisis, that rate was already well above the U3 rate before this pocket of time. If you look at that rate in the context of Friday's number, the unemployment rate is probably closer to 23%, slated to go higher. If you listen over the weekend to Minneapolis Fed President Kashkari, the Fed is being very straightforward here that they don't think the employment picture here has bottomed. We'll obviously get another claims number this Thursday, but clearly some of the numbers that we've gotten really since this survey was cut off for this past employment number was not included. So expectations will be for that number, the U6 number, to gravitate probably closer to 25 to 30%. When we look at this week, very full week. We start today with the quarterly refunding with three-year notes. We've got $96 billion in total to raise $39 billion in net new cash for the Treasury. We've talked about the Treasury's general account at all-time highs. We look at T-bills, cash management bills. We'll get more of that this week too, a couple of $100 billion. The reality is here, when you look at the fiscal side of the equation, you look at $3 trillion to date in purely liquidity. We haven't really started with stimulus yet. We do think short term there will be more liquidity needs, liquidity, not stimulus, and then on top of that, it is inevitable that we're going to get stimulus down the road. So the reality is the funding needs, although when we look at the deficit now, we're awestruck at these numbers, they're likely to grow, not shrink, in the coming months and the coming years. Now we turn to the Fed. On Wednesday, we get Chairman Powell at the Peterson Institute. It's the first time that he'll be speaking since the last Fed meeting. Obviously, we've had recently Fed fund futures trading negatively, implying a negative rate policy into 2021. Clearly, on the cash side, we have had negative rates, but there is a difference between cash and a formal policy out of the Fed. We've talked about this explicitly over the last couple of days. A few of the bigger investment banks have come out with opinions on this. We came out with an opinion on this prior to the last Fed meeting, really on two fronts. On a philosophical front, that we don't agree that negative interest rate policies have worked abroad, and then on a practical legal front, there have been questions in terms of whether the Fed actually has the ability to enact a negative interest rate policy with regard to the Federal Reserve Act. Whether the chairman addresses this on Wednesday remains to be seen, but the timing, given where the futures have traded recently, would seem to be very appropriate. In addition to that, we will get some high-frequency data, economic data this week, obviously with the employment number on Friday, the reopening of the economy, which seems to be happening, but very slowly and very unevenly. We've talked about that, and the notion here that on an economic front, we really need to grasp onto any data that we can get short term to figure out where things are at and where things are moving forward. So this week we'll get PPI, we'll get CPI, we'll get retail sales, and obviously we'll get another claims number. I'm Greg Farinello, and this is Monday Minutes.